Good evening and welcome. My name is Martin Jones and this is the London School of Business and Finance. And we are doing strategic business reporting tonight, SBR. ACCA SBR Strategic Business Reporting with me, Martin Jones. We are into the revision phase now. We are into November. November the 12th. I should be good at the date because yesterday was my son's birthday. So November the 12th, so we're into our second session of revision, second evening session anyway. And tonight we are looking at, as we've heard from previous sessions, as we heard in the tuition, all the questions are essentially the same. There isn't really much difference between a question 1, a question 2, a question 3, and a question 4. The examiner just tells a story and gets you to discuss it. And, you know, being more specific about subjects, there's an anything anywhere rule. So goodwill, which you tend to think of as a question 1 thing, that indeed can come up in question 4. And maybe, you know, leases, which you tend to think of as being a question 4 kind of a thing, can come up in question 1. In fact, when I say can, I actually mean already have. The exam isn't all that old. It came into existence in September 2018. It's not that long ago, is it? But already everything has been examined everywhere. So there's plenty of examples of goodwill being examined in question 1 and 2 and 3 and 4. Not in one exam, admittedly, but you know, these subjects wander all over the place. So really, to be honest with you, the questions are largely indistinguishable. However, let's be honest, there is a certain something about a question 1 that is slightly different about a question 2 and a 3 and a 4. So let's have a look at the question 1 on my schedule. And I'll show you my schedule in just a moment. But in the meantime, I'm going to say my hellos. So welcome to Wellers, welcome to Tamar, welcome to Luke, welcome to Jan, Taya, Greta, Marianne, Shamoya, Kieran. Oh, nice to see you, Kieran. I missed you yesterday. You need to submit your question, Farham, don't you, Kieran? I know you're trying to catch up, Kieran, but make sure you stay up as well. There's definitely some advantage to you know, being in with the crowd and delivering questions on time. I know you're trying to catch up, but still, if you can, do try and get Farham in ASAP. And when it comes to question Hill, I had to think about it then. When it comes to question Hill, make sure you do have a go at it this weekend. Galaxy, Emmanuel, Sherna, Adi, Ruda, Arifa. Hey, Arifa. Mwamba. I just lost my space there. Abdul, Wajiha, and Jenny. I just paused briefly there because I could see her audio was stuttering for a second. Welcome, Jenny. I'm just going to mute your mic. Oh, you've muted it yourself. Well done, Jenny. Great. Okay, guys. So as promised, I'm going to show you the schedule, which of course I have open. I'm going to share my screen. I've got various things open, actually. I don't know exactly what this is here. Oh, that's the answers to the question. Okay. So here is the revision sequence. And as you know, as you might imagine, we start with the easiest question, which generally speaking is question 2. So we did that last week. And then we move to question 1, not really for any reason other than we've got to do it. Let's have a go at it. These two, Banana and Hill, wonderful pair, but there are other question 1s, and you know, really, you should, to be honest with you, you should be doing all of them, and more of that later. However, as just mentioned when I was talking to Kieran, your focus for this weekend is to do question Hill, and it doesn't need much introduction, question Hill, to be honest with you. I'd like to give it a little bit of an introduction at the end of this evening, once we've got Banana under our belts. Yes, indeed, you can see it's question Banana that we're looking at. And as it happens, it's question 1 from September 2018, meaning it is, in fact, the first ever SBR question. I find it easiest personally to search for stuff using the search function in everything, actually, but also in Adobe. So in fact, I have used search, as you can see over here in the revision pack. You can see it's about 2/3 of the way down. It's quite a big document now, this, isn't it? 69 pages. So if you have indeed 69 pages, sorry, that is the 69th page. It must be about 100 pages. Wow, it's big, isn't it? So yeah, loads and loads of questions in here. If you are looking at the PDF, you might want to use the search engine yourself. The button's over there in case you've never used it. A lot of people don't use search in PDF. They don't realize it's there. That's where the button is, at least on my toolbar anyway. So there I am, ready with banana, all ready to go. You know the drill. I'm going to stop sharing for a second. Make sure you're all cool and ask for the thumbs. What's going on with that thing there? I say, okay, cool. Right, over here then. There we go. No chat. Oh yeah, a bit of chat. That document I was asking you about, the mid. So you're sorted now, are you, Wallace? Is that what you're saying?
So I was saying the document you first showed that with the questions, the one in the class, and then the very first page you showed.
Are you referring to the question bank, as it's called? The revision pack is two halves, isn't it? As we discovered last week, last Friday, was it? Last Friday, yeah, last Friday. So as we discovered, the revision pack is actually two separate documents.
What's wrong with your mate?
Together, isn't it? And hey, Kieran, it's two separate documents banged together. The first half is the older questions, and the second half is where we spend all our time, because those are the real SBR questions. The second half goes by the name PEP, but because I'm using search in the PDF, I'm finding myself going there straight away. But yeah, it's page 69 of that document. Cool. Kieran, you opened up your mic for a second there. Did you want to say something?
No.
Okay. I'll close your mic then.
Sorry.
No, it's fine again. It's fine, Kieran. There's no problem at all. No problem at all. Hey, Phil, nice to see you. And who else has just joined? Shamaz, welcome Shamaz as well. Well done, guys, for joining. So give me thumbs, especially Wellers. Make sure he is cool now. I think he is. Are you all good, Wellers?
Sorry, Martin. I think maybe I didn't make myself clear. You know, the very first page, which has got the question that we do in this session, followed by the homework. That page, where is it stored? Not the question bank.
Are you talking about the class notes?
The first page you were showing us, which has got the question that we do in the class, followed by the homework.
It's the revision banner in resources.
Are you asking me where to find the thing? What you asking me, Wellers? Where to find it?
Yeah, the one which
find it.
Which has got the dates, like the 12th, and then the question we are going to do, and the homework, where you find Farnham, banana, all those question names.
Okay, I think you're asking where do you find the documents I'm working in? I think that's what you're asking. So I haven't got Chrome open, so I'll go and open Chrome and I'll show you where you find it. So we have on our platform, we have a place called resources, and that's where I'll be sticking stuff. I stick lots of stuff up in FM, as Luke may remember, but less stuff here actually tends to be much less. But I will be sticking up the answer to Hill in there once you've had a go at it, guys. I'm going to try and make sure I don't put it up before you've had a go. But here we go. Where are we now? SBR Live Tuition. I think I've gone past it. SBR Live Revision. So what you do is this is your platform, right, Wellers? What you do is you come across to resources, and can you see there's the IFRS notes? That's the cheat sheet. You need that fella, don't you? So that's the IFRS notes. This is the article pack. That's what we're doing next week. You definitely need that. Here's the answers with gaps. But down here, can you see there is the revision pack? So the whole document is called the revision pack. It's a combination of the older questions and the newer questions. It's this document here. So this document here, where is it now? It's when you download it, which I have done, actually downloaded it. Of course, I got it emailed through from my superstar in India, Nivi, but once I didn't download it from Outlook, I actually downloaded it from the website. You know, the same place we just at. And when you download it, it comes down with this coding, which is RP/PEP. And what Nivi feels is that this is actually two documents banged together. That's how she perceives it. So if she perceives it like that, I perceive it like that. So there's the first half is the revision pack, which is the older 36 questions like Beth and so on. And then if you go about halfway through, it is literally about halfway through, you get to about question 36. There we go. And then you go, can you see how there's another title there? It's almost exactly halfway through. This is the PEP and this is the recent exams. And the recent exams start with specimen 1. They're all in chronological order. So they start with specimen 1, which is the first one that was issued by the ACCA. Then you've got specimen 2. Can you see at the bottom, the labeling is at the bottom there. There's specimen 2. Yeah. And then here's the first real exam, which is this one, S18. Can you see that at the bottom, Wellers? So that's the next exam. This is banana, actually. And then it does December 2018, then March and June 2019, and then September, December 2019, and then March 2020. So all the questions are all in chronological order as they were released by the ACCA. You got that, Wellers? Cool. So make sure you download all that stuff from resources. So what I was showing you was particularly this document, but I hope you picked up that there's lots more fun in there and you'll need it all. So that's the questions. This is the cheat sheet. That's the current issues article pack that we're working on next week. That's the answers to the revision pack. That's the answers. You definitely need that. This is Graham Holt's article. It's just taken straight from the HTML document on the ACCA website and turned into a PDF to make it easier. And there's your study planner. All of these things in resources Wellers. Okay. All right, guys, it sounds like we are ready to go, but I'll just ask for the thumbs up from everybody. Cool, great, let's go for it. Lovely. Shamaz, you're welcome to send me an email on that. It could be a bit tricky, however, because all the sessions have been scheduled already. But yeah, you're welcome to send me an email on that, Shamaz. All right, lovely. Let's get going. So let's get going. Here we are in question banana, which is in the revision pack on page 69. I'm going to open it up and then take you very naturally to the requirement, which is straddling the page rather annoyingly. You can see that this is 30 marks. You can see that the requirement on the second page is discuss and discuss. So it's 7 marks, 7 marks. It means make 7 points for each of B and C. Similar sort of story when you're up here. 8 marks means make 8 points. 4 marks means make 4 points. 4 marks means make 4 points. What is a little tricky is this thing here, which is draft and explanatory note. It's very odd, this requirement. The draft and explanatory note essentially means explain. And the examiner makes no distinction between explain and draft and explanatory note. First time I saw this requirement, I thought it, needed some sort of top and tail, the like classic introduction conclusion type of thing, but it doesn't. The examiner's answer just looks exactly the same as any other requirement explain, any other requirement discuss, any other requirement for advise. It's a bit odd, that, isn't it? First time I saw it was in this examination, but it's actually been examined a couple of times since. It basically means explain, so it's another example of a requirement that is indistinguishable from the other narrative requirements. So we're going to make 8 points just straight in the usual way, talking to the markers in the usual way. So let's find out what the requirement is. Draft an explanatory note to the directors of Banana discussing the following: how goodwill should have been calculated on the acquisition of Grape, and how the accounting entry which is required to amend the financial statements, financial director's error. This is a little nasty, especially if you're used to examiners that use their requirements very carefully. Your examiner, as you know, Graham, can be a little slapdash, and there's a certain thing that he likes to do in this area. He doesn't always do it, but he does really like it. He likes to make 3 mistakes, 3 errors with an S. And that is what happens here. There are 3 lines on goodwill, and he likes to make a mistake in every one of them. It seems to be his thing. He doesn't always do this, but it is a bit of a thing with him. So he cocks up the consideration, he cocks up the NCI, and he cocks up the net assets. 3 cock-ups, therefore, driving this answer. Now, what I'll point out first of all is that there is a mark for the calculation of goodwill, for the correct goodwill, for the appropriate goodwill, the goodwill that should have been recorded. That mark, however, you should firmly park at the bottom of your answer. What will happen, you see, is you will identify the error described in the consideration. And once you've done that, you'll understand what you're doing there. And then you'll do the same with the NCI, and you'll do the same with the net assets. Once you've worked your way through goodwill, explaining as you go, you'll find that the goodwill schedule at the end doesn't really take you that long. But you can imagine some students, they read this, calculate goodwill. So they calculated the goodwill, they got it right, and they got 100% of 1 mark. And therefore they got 1 out of 8. There is 1 mark for the calculation of goodwill, but if you completely ignored it, you could still score 7 out of 8. Because the question isn't really about the calculation, it's driven, of course, as we know, from this word explain, explanatory, explain. And that's really going to drive our answer. Can you see where we're going now? So have a look at it again. Can you see this word? Amend, that's a very handy word. The examiner also uses the word adjust in the same context as well. Amend, adjust. A really good way of communicating any adjustment in financial reporting is to use a journal. You don't have to use a journal, it's true, but on the other hand, the examiner will be using a journal, and so will everyone around you. These journals aren't really that hard, and I hope I'll be able to sell them to you. But if you do struggle with the journals, I do recommend you continue to struggle with the journals and try and get used to communicating using journals, because once you get into the groove with them, you don't need to be as good as an an F3 student. You don't need to be as good as an F3 student at journals. You just need to be okay. The basic idea that to make a debit go up, you debit the debit, that kind of thing. As long as you've got the real basics of double entry, you should be fine. And journals are kind of what the markers are expecting. It's what everyone else is going to do. So I would suggest you drop into line there. But can you see an answer starting to form already? There's 3 mistakes. We're going to explain the mistake and then show the adjustment. Explain the mistake and show the adjustment. Explain the mistake and show the adjustment. That's going to give us 6 marks, isn't it? That is going to give us 6 marks straight off. And wait a second, what are we doing now? SBR. And the law is in SBR that we have to start with a bit of knowledge. So we're going to kind of have 6 points with an intro and an outro. The outro will be the actual goodwill corrected, and the intro will be a little bit of knowledge, and that's it. That's our 8 marks. So our structure has already arrived on our platter. That probably isn't enough to get started, but let's go and have a look at the scenario. Now, it's horrible the way it does this in the question. The thing I'm referring to there is so difficult to show to you that I'm actually struggling with this, but this ridiculous situation was the situation in the real exam. Can you see how this paragraph straddles a page? Oh, it's horrible, isn't it? But yes, the way that it works is basically paragraph 1, now referred to as an exhibit. Paragraph 1 refers to exhibit 1, refers to requirement 1, exhibit 2 refers to requirement 2, etc., etc. So there is this really nice thing in SBR, which is really different to anyone who's done SBL. You know, in SBL, you get a huge long exhibit, as it's called now. You get a huge long scenario, which you have to sort of plow through, and you know, little bits from the back end are relevant at the same as the front end and all that sort of stuff. There's lots of awful things that happen as regards SBR, but this compartmentalization of information is great, because it means we don't have to read, you know, we don't have to read anything about the bonds until we get to the end of the answer. We don't have to read about melon until we get to melon. We can just concentrate, not even on strawberry. We don't even need to read strawberry. We just need to read grape to answer about grape. So that is great. We're going to have a look at grape when we answer grape. That is our strategy. Oh, probably we should have a look at the background as well. So let's have a look at the background. I'm going to go full size again. Banana is the parent of a listed group of companies which have a year end of blah. Banana has made a number of acquisitions and disposals of investments during the current financial year, and the directors require advice as to the correct accounting treatment of these acquisitions and disposals. The acquisition of grape. On the 1st of January 2007, what date is that? That is halfway through the year, isn't it? Halfway through the year, Banana acquired an 80% equity interest in grape. The following is a summary of grape's equity at acquisition date. So we've got the equity share capital is 20, the retained earnings 42, the other components of equity is 80, giving us an equity balance of 70. Now, of course, this equity balance has been taken from the books. The technical name for the value taken from the books is the book value. And of course, equity equals net assets. It's that kind of UK balance sheet that we rather like. Assets less liabilities equals equity. So if we know the book value of the equity, we know the book value of the net assets. And you can be damn sure it's wrong. You know, that book value will be an understatement of a fair value. That's bound to be wrong. That's going to be one of the errors that we'll be finding. Let's read on. The purchase consideration comprised the 10 million of Banana shares, which had a nominal value of 1 and a market of 680 each. Additionally, cash of 18 million was due to be paid on the 1st of January 2009 if the net profit after tax of grape grew by 5% in each of the 2 years following acquisition. The present value of the total contingent consideration at the 1st of January was 16 million. It was felt that there was a 25% chance. It was felt that there was a 25% chance of the profit target being met. At acquisition, the only adjustment required to identifiable net assets was for land which had a fair value of 5 million higher than the carrying amount. This is not included within the 70 million equity of grape. It's a real jumble. It's a horrible paragraph. What it tells you at the end of that paragraph is what we guessed already, which is the 70 is wrong. Can we have a look at that again? This, what's this? This is not included within the 70. Okay, so that 70 is wrong. Right, okay. How much is it wrong by? Let's see again. What is it? At acquisition, the only adjustment required to the identifiable net assets of grape was for land which had a fair value of 5 higher than its carrying amount. So that 70 needs to go up by 5 because it's undervalued. It's being, you know, the land is being valued at book value rather than fair value as required by the standard. So we've identified our first error. And funnily enough, our first error that we've identified is actually on the bottom of the goodwill schedule. The goodwill schedule is, of course, consideration, NCI, and then net assets. And it's actually the net asset error that we have first. Let's find out about the consideration error. I think that's what comes to us next. You might have guessed. There are 2 share issues. One is a share issue that has happened, and the other is a share issue that might happen in the future. Did you spot it? There's that key word, key tiny word, if. If indicates what's called contingent consideration, which is actually quite common in the SBR examination. And that contingent consideration, if it flows, will flow in the future. And of course, if it flow in the future, you can guess probably it's missing from the FS. I don't know for sure, but let's see what shows up as we work our way through the story. So, well, there you go. You can see we don't wait very long. Goodwill for the consolidated financial statements has been incorrectly calculated as follows. The share consideration has been calculated as 68, which is not completely wrong. It's just missing the contingent consideration. Can you see that the guy who worked out the 68, he's not a million miles out, because what he's picked up is that there's 10 million shares that have already flowed and that their value was 680 each. So, you know, that bit's fine. The immediate consideration that flowed 6 months ago has been recorded appropriately. But, you know, there's this word right next to it. You can see that there. Additionally, the addition of additionally hasn't been added. So what's missing is the contingent consideration. Now, what I'd like to do now we've identified there's an error there is to go back and have a look at it. It's a bit tricky because there's a couple of percentages knocking around, but the important one is this 25% chance here, and indeed 16 just next to it. What we're going to try and do is we're going to try and get a fair value for the contingent consideration. Let's have a read of it again. Additionally, cash of 18 was due to be paid on the 1st of January if the net profit after tax grew by a percentage that doesn't matter in each of the 2 years following acquisition. Present value of the total consideration was 16 million. So the discounting has been done for us. The 18 has been discounted down to 16. Thanks very much, Mr. Examiner. But what hasn't been accommodated is the probability of that 16 flowing. I mean, what we want is the fair value of a 16 million cash flow. And the fair value, of course, is the market value. It's like, oh, how on earth would you get a market value for a 25% chance of getting 16 million? It's like, well, in real life, that would be a nightmare to try and value. But you're not in real life, you're in an exam. Why not just tell you what? Multiply one by the other. That's going to be easy and it's bound to be the answer. And you're quite right, of course. The fair value of a 25% chance of 16 is roughly 25% of 16. The fair value of 25% of 16 is roughly 25% of 16, which is 4. And as the examiner says there, it is additional. So what we should do with that additional consideration is add the 4 to the 68. And you can see as we're working our way through here, we're starting to understand what's going on. So we've identified that the 70 is wrong, should actually be 75. We've identified that the 68 is wrong, it should be 72. I bet you that 14 is wrong as well. So let's hear what's wrong with the 14 as we work our way through the rest of the story. So we're now just here, just at the bottom paragraph here. The financial director did not take into account the contingent cash. Oh, there you go. So confirmation, the cash consideration, the contingent cash consideration is missing from the consideration. The financial director did not take into account the contingent cash since it was not probable it would be paid. Additionally, he measured the NCI using the proportional method. And measuring the NCI using the proportional method is equivalent to doing partial goodwill. So he's done partial goodwill. So I guess we're going to be told that's wrong. Additionally, he measured the NCI using the proportional method and SS, despite the group having the policy of fair value, in other words, full. The share price of Grape at acquisition was 4.25 and should be used to value the non-controlling interest. Now, I can't do that in my head. I'm not even going to try, but I'm guessing that the NCI should be bigger than 14. We'll work out what the difference is, and then we'll push the NCI up. And what we're going to do when we do each of these is we're going to explain the error and then show a journal adjustment for each of those. As we work our way through, that structure will automatically give us 6. we get one in the bag immediately by our knowledge mark. You know, this is about goodwill, so we just do something simple describing how goodwill should be measured. And then what do we do? And then we conclude at the end by really calculating goodwill. I've shown you the portal already, and I'm feeling like tonight is the night to sit back and go into Word. So that's my plan. Because I'll be using Word, I'll actually create a document I can send to you. Not that you really need it because you have the answers already, but I think that might be, I do feel like, I know I've got the answers in front of you already, but I do feel like typing in front of you, but this time in Word, so I can give you a document that you can take away. So that's what I'm going to do. I'm going to open up a Word document, but before I go any further, I'm just going to check that everyone is cool and we're all ready to go. So, would the consideration be deferred? Indeed it is, you're quite right. Any questions, guys, before we go for the thumbs? Luke, fire away.
Technically speaking, if a company was to issue shares as a consideration, wouldn't that dilute the shareholding and then the market value would decrease?
you can't do it without the agreement from the rest of the shareholders, but you can get that. It is done that way.
Okay.
Yeah.
Would you ever get a mark by stating that in the exam?
Yes, there is a mark available for that, but in this schedule, it's so tight. Can you feel it? Can you feel it's not? You need your knowledge. You know knowledge. You're not doing SBR, are you? So we'll just get one knowledge point, and then it says explain and adjust, and there's 3 errors. That's got to be 6. And then it's not working here, is it? So what you're saying is definitely worth a mark, but probably not in this question, because it's just outside the periphery, and therefore it's tight already with the 8.
Oh, okay, got it. Thank you.
Lovely. Emmanuel, were you about to say something? Your mic open.
What would be the best way to kind of look at these questions? Would it be kind of a line by line basis? Because you've got a lot of information inside of great.
Even those little paragraphs, which is not actually that big. Have you done SBL?
Yeah. I've done
so
SBL.
You know how massive these things are. So yeah. I mean, relative to that, it's tiny. You need to toughen up, Emmanuel. There's definitely 2 different ways of doing it, and you do what works for you. Honestly, I was thinking of just bashing out the knowledge mark, just starting. The question says recalculate goodwill, so I'll start with the knowledge as to how goodwill works. Before I read anything, you can definitely read a bit, write a bit. Definitely works, Emmanuel.
Yeah.
For most students, they find quickly whizzing through the scenario works as well. The reason that works, that quickly whizzing through the scenario works as well, is because, students that are able to quickly whiz through the scenario are quick because they've seen the equivalent before. Emmanuel, this is, I'm saying toughen up, but this is the first time you've seen a question 1 from the examiner. So, maybe tonight is not the night to toughen up. But over the next few weeks, you'll be practicing lots of question 1s, and I hope you'll be looking at it like, oh yeah, I know what's going on there. Yeah, I get the gist of that. And you're not really slowing down and looking at the daisies in the way that I was tonight. You get the idea?
Yeah. All right.
But either strategy, guys, play with both strategies as you're working through your practice. Read a bit, write a bit works. It's a bit rough and creates a bit of a rough answer, but who cares as long as it delivers. The other one is you get the holistic view where you quickly whiz through and then you start typing. I just did a holistic answer this time, but I think when I was doing plastic in particular, I did read a bit, write a bit, read a bit, write a bit, and both of these strategies work. So read a bit, write a bit works, read the whole lot works as well. The only rule is go fast. Okay, should we start? Thumbs. All right, lovely. As I say, I'm going to use Word for tonight. So I've got a Word document open. I'm going to bring you over to it. Here it is. And we'll go for some ginormous typeface. 16 sounds about right. And I'm a big fan of Times New Roman, so I'm going to go for that. So here we go, SBR revision 2. And the date is the 12th of the 11th, 2020. Well, that looks strange, doesn't it? on. That's better. Great. So question banana, and we start with A1. Great. Knowledge mark, goodwill. Very natural. Something simple like this is calculated by bringing together the fair value of the consideration and fair value of NCI and fair value of net assets. It's really tricky, this. The examiner has said, especially after this question and the following question, that he feels that that's so generic you need to somehow attach it to the question. It's a bit strange, but it just seems to be a rule here, so I'm going to attach it to the question. This means the contingent consideration must be included. Something like that. There you go, first mark. And now I'm into consideration. So consideration. And in this one, what I'm going to do is I'm going to explain and then we're going to adjust. The contingent consideration should be measured at FV as follows. And we've got FV is equal to 25% of 16 million and therefore equal to 4 million. So what we're seeing here is heading sentence, sentence, then heading sentence numbers. You know what's coming next, don't you? Of course, it's heading sentence journal. This is particularly the area where we use all three forms of communication. So the consideration, adjustment. Thus, the following adjustment is required. So as you saw me doing last week, I still like tables, even when I'm working in test reach. So I'm going to make the investment, which is a debit, go up. Wait a second, hang on, I've missed a bit. Now what we're going to do is we're going to make the investment go up, the consideration go up. If you make the consideration go up, what effect do you have on the goodwill? So we have the consideration plus the NCI minus the net assets gives us goodwill. If we push up the consideration, we push up the goodwill. Another way of saying this, in fact, is we correct for the undervaluation of goodwill. Goodwill at the moment is undervalued by 4 because the consideration has been undervalued by 4. So we whack in 4 there, and then the contingent consideration hasn't been paid. Well, that makes it a liability. So we need to recognize the liability as a liability because we owe the guys this potential outflow. So that's our first error sorted. I quite like going down the schedule in order, consideration, NCI, and net assets. There's no particular reason for doing that, but it does flow for me. So that's exactly what I'm going to do here. So here I go with NCI. I'm going to do the numbers again. The NCI should have been valued as follows. I don't actually know the number yet. I'm just going to find out what comes off the end of my fingers as I bash through. I picked up that 425, but I didn't really pick up anything else, to be frank with you. So we're supposed to do something with the 425. Where's it gone? There it is. There's the 425. What are we supposed to do with that? The share price of Grape at acquisition was 425. It should be used to value NCI. Well, NCI is how big? What's the ownership? Oh, 80%. So it's 20%. 20% of what? Oh, 20% of the share population. Ah, how many shares are there? Oh, there it is there. And do you see that is a bit tricky because there's numbers all over the place on that one, isn't there? So that one is one that you do have to practice a few times to pick up the information from different parts of that quite long extract. So the 425 is at the bottom, the 20 is there, the 80% tells us the 20%. So let's now use that information. I'll build the answer a little bit slowly. So we're talking 4.25 multiplied by, oh, can you believe I've forgotten already? Was it 20? 20 million shares. 20 million shares. Now, I am going to stop there for a second. That seems slightly bonkers, but I am going to stop there for a second. I'm going to stop for a second and pick up this stinky, horrible, dirty, filthy piece of modern technology, modern-ish. It's called a calculator. We try and keep it on our desk as much as we can, right? But hey, in question one, it comes into your hand. As soon as you pick it up, you're scoring 0 marks per minute. So try and keep it sitting down. So here we go, 4.25, oops, not even on. 4.25 times by 20 is equal to 85. Now what that is telling you is the fair value of the whole population. And of course we don't, we're not talking about the whole population, we're just talking about the 20% from NCI. So we times that by 20%, and that'll give us the fair value of NCI. So we divide by 5, don't we? And that gives us 17, so it's 17 million. Good, and then we make the adjustment. So here we go. This gives this adjustment. So I know I'm not saying an enormous amount with my heading sentence, but I am still discussing, I'm still explaining, it's still an explanation. It's not just a journal. Just journals, you're really making it difficult for the markers because they're supposed to give you 0. So make it easy for them, give them a little sentence so they go, yeah, there's your mark. It's more important to do the sentence than it is to get the journal right, to be honest with you. So here we go, we are going to get the journal right. As you know, I like a table. Please use indents if you prefer that. So different ways of doing this. You do this as you want to. What I'm doing is I'm pushing up the NCI. And if I'm pushing up the NCI, which is on the bottom of the balance sheet, then I'm pushing up a creditor. If you push up a creditor, then you credit the creditor. Please, use double entry exactly as works for you. Oh, wait a second, we've already got 14 on the balance sheet. So if we want 17 on the balance sheet, we only actually want an increase of 3. So we want an increase of 3. And when you make NCI go up, what effect do you have on goodwill? So consideration plus NCI gives you goodwill. If you push up consideration, it pushes up goodwill. If you push up NCI, it pushes up goodwill. Right, okay. We're not actually pushing up the customer loyalty, you understand. We're correcting for an undervaluation of goodwill. We're not finding customers for our subsidiary here. That's not what's happening. We're not pushing up the underlying goodwill. We're just correcting for an undervaluation of goodwill is what we're doing. Great. Last one. That was the land. Land? It was land, wasn't it? The net asset adjustments. All the net assets must enter at fair value. as the as only the land had a fair value that differed from a book value, only one adjustment is required. You can just guess, in real life there could be loads. And I'm going to give myself a fresh new brand new page there. You've got infinite pages you might remember from your test reach, but for me, I using standard Word, I'm making sure I break down onto a new line. So here's my land adjustment. Well, I'm going to phrase this slightly differently. The following pushes the land up. Again, as you know, I do like a table here, so I'm going to insert a table. So debit to land of the 5. The figure was 5 to push up the land. And, oh, wait a second, must be a credit to goodwill. Oh, that's counterintuitive. What's going on there? Don't forget, we're not changing the fundamental goodwill. We're not changing the goodwill. We're just changing the measurement of goodwill. What's happened is they have made a couple of errors in the measurement of goodwill, 3 errors actually. This one is a bit tricky because what you're doing is you're increasing the sausage in your calculation of goodwill. Of course, we go net assets plus NCI minus net assets. If the net asset grows by a figure of 5, if the net asset grows by a bigger figure of 5, and then we deduct it, the goodwill itself goes down. So that does fit with our expectations, with our ideas as regards the effect on goodwill. And then I'm hoping that you'll agree with me, by the time you've done those adjustments and worked your way through, the actual calculation of goodwill, which would have taken you forever if you'd done it first, is kind of quickish. It's still not the quickest of things, but that's what practice is all about. Oh, just give me a second. My laptop's just dying. Yeah, the power's dying right at the beginning of the lecture. I've been using my son's PC today, and this one's been sitting in the window. I think it was fully charged, but it's pretty cold here in London today, so that's why it's dry. There we go. Powered it up, no problem at all. So here we go. There's a good word. So goodwill should have been measured as follows. And it doesn't look very generous, this schedule, for just 1 mark. It isn't very generous, to be frank. But once you've done everything, I think it's doable. 1, 2, 3, 4. There we go. So here we go. We've got the fair value consideration, the fair value of NCI, and the fair value of net assets. And that gives you goodwill. We'll go for the abbreviation. As you know, I'm quite fond of the percentages. I'm not sure in this case you actually need them. You very often do. I'm not sure you actually do in this question, if I'm honest. Then we're going to have a little working. We'll definitely be using that. And then we've got the figures for the sub itself. So the fair value of consideration was the original 68, which was recorded by the accountant, plus the 4 that we just worked out, which gives us 72. The NCI, well, you can work it either way, or you just not show a working at all. You can just, yeah, let's just put in the 17. Let's be a bit more honest about this. Just whack in the 17. We worked out already, right? And then the fair value of net assets was the original 70 book value plus the FVA, the fair value adjustment of 5, gives 75. But look at the sausage round that 75. I don't think you really do need to add down here, but what the heck? It's not a biggie. Plus 17 minus 75 equals a figure of 14. So the goodwill should have been 14. You can see that that schedule is a challenge in 1.8 minutes. But if you try to do it first in 1.8 minutes, it would have been impossible, wouldn't it? But the really important thing to understand is that is just one mark, as in are all the other points that are above. Lovely, guys. I can see there's a little bit of chat, so I'm just going to stop sharing and see if I can help you guys out. So there we go. Great. So here we go. Oh, lots of questions. Would the consideration, yeah, okay, debit, yeah, debits and credits. Where are the figures for NCI coming from? Again, yeah, I can show you that if you like. They're quite tricky, right? Here we go. So the question tells us that for the purposes of, let's just clean this up completely. For the purposes of the measurement of NCI, we use 425. 425 tells us the value of each share. But what we want to do is value the whole company. So to find the value of the whole company, the whole equity, we need to multiply by the number of shares. The number of shares is 20 million. That's a little bit dodgy because that's actually $20 million. But the equity is $1 each, therefore that $20 million is also 20 million shares. But 20 times 425 tells us the value of the whole population. We're talking about the NCI, and the NCI is the other 20%. Give me a cool if you're okay with that. Wajiha, and I'll carry on. Where are the figures? Yeah, okay. Would it have been a waste of time to make points about the two ways in which goodwill can be measured? Yes, I think it would, Sherna. Yeah, I think it would have been a waste of time. If they were, you know, what we're trying to, it would have been a waste of time, as in it would have been a good 9th point, and we've already got 8 out of 8. So if we come back to the, what you're doing is you're delivering some knowledge, right? Which is okay. It's okay to deliver knowledge, but the only real knowledge that we need here is that goodwill is made up of 3 things, and everything should be at fair value. That's the only knowledge that we really need. It's not forbidden to talk about. There is a choice between full and partial, but they've already made the policy choice between full and partial, and the question isn't really about the policy choice, it's about the cock-ups that they've made. I feel like it's a bit hard on you, Shanna, but I feel like that's maybe a 12th or a 13th mark, and in this 8 marker it probably isn't even the 9th. It probably is a little bit away. It's not irrelevant, it's just you know, what you're really being asked to do is look at the errors and correct them. So what you should do is, if you think, if the examiner says, what are the errors, correct them, then you identify the errors, explain the errors, and then correct them, and then see if you've got enough time to do other stuff afterwards. That would be a nice way of doing it. So if you have some stuff around the outside, just pop it in your back pocket, and then just answer the question directly, and then look at the watch. Is the time to say anything else? No. All right, move on. That'll be a really good strategy for dealing with that kind of thing. It's definitely not wrong. It's just, as you can see, we've already got 8 by the direct route. I was a little bit quicker today, wasn't I, than you've seen me go before, and that was kind of deliberate to get closer to exam speed, so I can kind of toughen you guys up. Underland, what does BV stand for? The most important thing, of course, is to use abbreviations, lots of abbreviations. So we use FV for fair value. As soon as I say that, Wajiha, you know, of course, it's book value. Do use abbreviations, but if you don't know an abbreviation, writing out book value is fine. You know, so balance sheet if you want to, or B/S. The examiner is expecting B/S, but you can write balance sheet in full. Isn't balance sheet the strangest of abbreviations? Why is there a slash? Is it the balance over the sheet? It's very weird, isn't it? Why is there a slash in B/S? What a strange abbreviation that is. But it is the standard abbreviation, so it is what the markers are expecting. The adjustment, the journals seem pretty confusing. What's the best way to work these in your head in exam pressure? Practice, I think. I think what this is showing is probably that you do need some practice at journals, which I think we know already, Shamaz, to be honest with you. You are an auditor, and therefore, you know, improving on your journals will be very useful in your career, as well as also in the SBR exam. I know we're focused on the SBR exam, but any effort that you put in on your journals, you will be rewarded outside in the real world. But I think the simplest, there's all sorts of different ways of doing this, but I think the simplest way for you, for Shamaz, is just look at a thing and see if it's going up and down. So if you have something like what have we got here? So the first one was an unrecognized liability. So we needed to push the liability up. The liability is a creditor, so we credit the creditor. That was the liability. And then the goodwill goes on the other side. Another one would be the next one. The NCI was understated. We need to push the NCI up. The NCI is a creditor, so we credit the creditor to push it up. The land is an asset. Assets are on the top of the balance sheet, therefore debits. When you push a debit up, you debit the debit. They're actually all doing the same thing, aren't they? I've just realized now, I've not noticed before. The debit is going up, the credit is going up, and the credit is going up. So all you do in double entry to make something go up is do more of itself. So if the thing is a liability, you add in more credit, and if the thing is an asset, you add in more debits. That's probably the easiest way of improving on your double entry. I think that's probably the easiest way, Shamaz. If you want a mnemonic on this, Shamaz, I don't know if you do, but what I did many years ago when I first started this, I did physics at university, and it's a bit of a shock to the system to try and learn double entry. I think that's true for anyone, isn't it? Double entry is just an alien world, and the first time you learn it, whether it's at school or it's in my case, I learned it in practice. My first day of work was the first day of college, and I just invented this. And there's variations on a theme, so I'm sure you've seen something similar yourself. I just came up with diesel to help me out. So debits are expenses and assets, credits are income and liabilities. If you want your income or liability to go up, you credit the liability. If you want your expense or your asset to go up, you debit the expense or the asset. And if you want to do the opposite, if you want your expense to go down or your assets to go down, you do the opposite, you go to the other side. So debits equals credits, expenses, assets, income, liabilities was the little mnemonic I came up with. Probably somewhere around the 4th or 5th of September 1990, my second or third day of my training contract. So something like that. But as long as you've got the basic idea that this is the thing, you don't go too far with your double entry. You don't start, you know, winding all the way back to F3. In F3, you've got some really difficult stuff like, you know, dealing with VAT and stuff like that. Don't try and become really good at double entry. Just get the basic idea that when you make a debit go up, you debit a debit to make it go up. That's the basic idea. Oh yeah, Kieran, yeah. Yeah, dead click. I've heard of dead click since. I quite like dead click. Yeah, I've only recently heard of dead click actually, but diesel I came up with myself. I don't bin double entry, Shamaz. I think that you're right to say you should focus on your stronger areas, but I think you should keep your weaker areas ticking over as well. It's a really useful communication tool in SBR, being able to do double entry. It's a bit strange really, because there's probably more double entry now in SBR than there ever was before, and there is in F7, so it's a bit odd, but it's a very useful communication tool. And the standard of double entry is not high in SBR. The accounting is high, but the double entry is pretty simple. So as long as you can get the basic idea of, to make a debit go up, you debit the debit, I think that will be enough for you. But you do need practice, of course, like everything. All right, lovely. I think I've caught up with all the chat. Do you want to give me some thumbs? Should we carry on? Now have a look at the fruit that is described in the next requirement. Have a look at the fruit that is described in the next requirement. We go from looking at grape to looking at strawberry. Maybe I should find a pink highlighter. And you can see, actually, rather unusually, strawberry is split between two requirements. It's actually quite a clever way of examining this. It's basically 8 marks on grape and 8 marks on strawberry, but there's a split between the 4 marks here. It's quite cleverly done for a reason that you'll see in just a moment. What that means is that, yes, indeed, after the break, we're going to have a look at this horrible paragraph that splits the page. And I know what you're thinking. You're thinking, flipping LSBF, I can't believe that Nivi didn't do this correctly. Well, actually, this is not Nivi. Nivi has simply copied the original exam question. I mean, just look at that. Just look at that. This is one extract, which, okay, admittedly in CBE has now been tidied up. But in the original examination, the paper really was like this. It was paper, of course. The paper really was like this. The examiner couldn't put his cursor there and hit shift return. Have I said that right? Yeah, shift return. The examiner couldn't be bothered to do a hard return. He cares so little about you, he can't even be bothered to put one paragraph on one page. That's a wonderful way of building up hate for the man. Hate him for his presentation. Let's take a break, and when we come back, we'll have a look at strawberry. See you in a moment, guys. Hello guys, welcome back. Let us continue our little battle with banana. So we were just starting to have a look at the requirement as regards strawberry, and here it is, the scenario as regards strawberry. Let's go and have a look at the requirements as regards strawberry. Here we go, just use a bit of back button there. Draft an explanatory note to the directors of Banana discussing the following: why equity accounting was the appropriate treatment for strawberry in the consolidated financial statements up to the date of disposal, showing how the carrying amount of the investment in strawberry just prior to disposal. Frankly, that's quite a challenging requirement to deliver in 4 marks. Quite a challenging to keep it that small. Perhaps classic, gosh, I'm struggling to say it, classic CACA is the way forward. So here's the knowledge, here's the application, here's the knowledge, here's the application might be a nice way of doing it. You don't often get this kind of thing where the examiner actually tells you the answer, which is a bit odd, isn't it? Why equity accounting was appropriate. So he's done equity accounting, and for once in his life, it's not wrong, it's right, and it's a bit shocking, for him to get something right rather than get something wrong. So he's even told you it's equity accounting, but he hasn't told you why he's right. He is right, he says, but he wants you to tell him why he's right. A bit weird, that doesn't happen very often at all. You know, of course, however, that equity accounting is the form of accounting for associates. And associates are defined by influence, and influence is the power to participate in management policy. So we whack down that knowledge and then we extract some evidence of participating in management policy. So remember who you are in this story. We know who we're talking about, it's strawberry. We're banana. So what we're going to do is look for evidence in the scenario that we, banana, are participating in their strawberry day-to-day management. That's what we're looking for. And then once we've confirmed that the influence exists and the associate is an associate and equity accounting is appropriate, I guess then we define how equity accounting works and then show how the numbers should be applied to the scenario. That would be a very nice way of doing it. It's definitely not the only way of doing it, but it is a nice way of doing it. I really think read a bit, write a bit is appropriate here. So it was Shimaz, no, it was Emmanuel was asking about this. You found the first scenario quite overwhelming, I think, Emmanuel, but I'm cheating a little bit here. Of course, I've done loads and loads of these before, and once you've done a few of these, they do tend to sort of form a formula. The examiner's rather fond of this thing where here's a story, I make 3 cock-ups. It does seem to be a bit of a thing with him. But this next one has got loads going on. It's much denser, and I find read a bit, write a bit works for me in this area. But to be a good boy, I'm going to have a little look down at the rest of the requirement on strawberry, how the gain or loss on disposal of strawberry should have been recorded in the consolidated financial statements, and how the investment in strawberry should be accounted for after the part disposal. So it's a really tricky story, but you can probably guess from the story there's a couple of overs with an at somewhere in the middle. So at some point in the middle, we lose influence over strawberry. This event is known as a disposal, and therefore we're going to record a profit on disposal at disposal. Before we lose influence, we have influence, and we need to do equity accounting, and after that we've got some other kind of accounting that we're going to talk about. So we're going to talk about an over, an at, and finally we're going to talk about an over. You can see how tricky the geography of this question is, and therefore it really is actually very helpful to have the 8 marks split into 4 and 4. So I'm really very strongly feeling read a bit, write a bit. I'm actually going to go so extreme, I'm going to go straight for it. I'm going to actually get myself a fresh new brand new page, put the title of A2 and indeed the title of influence, and whack it down. Influence. So yeah, you've got to be able to regurgitate these definitions at speed. Influence is the power to participate in management policy. Influence gives rise to an associate which is carried using equity accounting. Nice. So there's my knowledge, not applied to the scenario at all. I haven't even read the scenario. So now I'll go and read the scenario. And, you know, the examiner's got his favorite here. There's a particular thing he loves to do when it comes to evidencing influence. Let's go and see if we see what we see. So the acquisition and subsequent disposal of Strawberry. So there's a big hint actually in the heading there. Banana had purchased 40% equity interest in Strawberry for 18 million a number of years ago, and the fair value of the identifiable net assets was 44. Now, what you can see there is there's these numbers jumping out at you and kind of attacking you. Just ignore the numbers. We're not interested in numbers. What we're interested in is influence, which is a people thing. Since acquisition, Banana had the right to appoint one of the 5 directors on the board of Strawberry. There's our evidence. Nice. Let's quote. Yeah, that's correct. Control B. Directors. Yeah, let's just quote. Since incorporation, Banana had the right to appoint one of 5 directors. Therefore, Banana had influence over Strawberry and equity accounting applies. So how does equity accounting work? Let's get the knowledge for that. Equity accounting. Oops. This uses the formula that carrying value is the original cost plus our share of the growth in net assets since purchase. How on earth did you get another sentence for that? Oh my days, that's really difficult. I think I'm going to slap something in actually. I'm not sure it is relevant, but I'm going to slap something in just to make it longer. I'm really looking at the possibility of trying to get this up to about 20 words. So I'm going to go for this. The growth in net assets is equivalent to profit since purchase. And really that's just a bit of padding. I could have been talking about my granny's dog just to try and make that sentence a bit longer. The punch really comes in the first few words. That's the knowledge. Then I'm going to apply it to the scenario, which is the story's called Strawberry, isn't it? So let's get that down. So the exit carrying value of the associate should be, and heading sentence numbers is the associate. It's just cost plus growth, and I did see the cost. Let's go and have a little look at it. Did you see it? I was kind of trying to ignore it, but I couldn't help it. Just sort of jumped out at me. 18. Banana purchased 18. So we have the cost. Let's whack the cost in. There's the 18. And then it's our share of the growth. And I think you, being honest, you did pick up on the 40%. Me too. I saw that as well. Now I just need the growth in the net assets. I think we've been told the entry net assets as well, haven't we, quite early on? 44. So there's the entry net assets. So the entry net assets are here. And apparently this asset has been sold during the year. We just need the exit net assets. Since acquisition, Banana had the right to appoint. Oh yeah, we've done that. The investment has always been accounted for as equity accounted for in the consolidated FS, which is right. It's very unusual for Graham Holt. Banana disposed of 75% of its 40%. Oh, that's really interesting. So it hasn't sold the whole lot. We'll come back to that in a second. Banana disposed of 75% of 40% for this figure on this date when the fair value of identifiable net assets were 50. Oh my days, isn't that awful? I remember this question. So the two, not only are the two net assets separated by a couple of lines of dense scenario, they're actually on separate pages. I remember it was on separate pages in the original exam. Absolutely horrible, isn't it? So very hard to see that when they're on separate pages. I think it was like that, you know, one was the bottom of the page, the other was at the top of the page, really nasty. But you can see the figure 6. So it's 50 minus 44. So that's 6, isn't it? Oh, excuse my throat, it's very sore. Got myself a tea here, but it's probably going to be too hot. I think I'll go and put some water in that tea and see if I can soften my throat.
Guys, how did you just get the 6 then? 50 minus 44. Is that net assets? Does anyone know?
Yeah, it's a change in net assets from the date of, I think, the year end compared to the date of acquisition.
All right, okay, thanks.
Yeah, well done, Luke. That's right. Thank you very much. Yeah, it's not particularly easy. I mean, the idea of the net assets growing from 44 to 50 is not really all that difficult, is it? What's really difficult is picking it up in the question because of this separation. This is one of the things of dealing with Graham Holt's questions. You know, often the technical subject is quite hard, but it's more the presentation of the information that's challenging. So the net assets are 50 at the point of disposal, at the point of measurement, at the point of disposal. And when they entered, they were at 44. And the increase from 44 to 50 is 6. So that's the increase in the net assets, and we want our share of that 6. So 40% of 6 is 2.4. We then add the 2.4 to the 18, and we get 20.4. And that's the exit carrying value that we're going to carry into the next part. So we'll have a go at the next part now. Very closely related. And it is a little bit bonkers. There's so much it's asking about, but did you pick up what it was asking? What it's asking us for is basically the profit on disposal. How the gain or loss of Strawberry should have been recorded in the consolidated financial statements. I mean, just that, you know, is like 20 marks. You can't do this properly. And can you see that important word and how the investment in Strawberry should be accounted for after the part disposal? It's like, oh, you're kidding me, man. You're kidding me. It's just really, really, really far too much that you can possibly do properly in 4 marks. So we're going to have to cut corners. But anyway, this is still SBR. You've got to whack down your knowledge before you apply it to the scenario. So what knowledge do we have about disposal? Well, of course, it's all about the pop stars. Do go back to your chapter 2 and practice the pop stars. We know that when there is a change in relationship, we go through 0. Going back to the percentage as given in the question, the percentage as given in the question is a bit tricky. what we've started with is 40%, and then we sell 75% to 40%, which is 30%. So we're dropping from 40% down to 10% and actually selling 30%. But as you can see, we lose a position on the board. Have I read that already? I don't think I've read it, have I? So let's read it now. At that date, that's the date of losing influence. At the date, Banana lost its right to appoint one director on the board, so we lose influence. We're clearly dropping down the schedule from an associate down to a simple investment. It's an equity investment. So it's gone from being an associate to being an equity investment. We'll decide what kind of equity investment in a moment. But we've definitely lost influence. So what we're going to do is go through zero. We're going to pretend that we sold all 40% and bought back a 10% investment. And that's the knowledge. I guess it's kind of the knowledge with a bit of application in there as well. So that's how I'm going to enter my answer there. The idea, you know, of a disposal being a loss of influence event. Disposal. The sale of the 75% of the 30% of strawberry results in a loss of influence. This must be recorded as the sale of the whole 40% associate and the purchase of a 10% investment. Very, very tricky to, you know, edit this just down to 2 marks, because then you've got to do the loss on disposal, I guess. So here we go. Here is the loss on disposal. That's a nice sentence. Now be careful, of course, this loss on disposal is the loss on disposal of an associate. Oh, I'm not doing a schedule. Why am I not doing a schedule? Huh. Inserting a table, in other words. I love tables, don't I? So I'm not exactly sure how many I need, so I'll just start like that. Actual sale proceeds. You know what's going to happen. We're going to have actual sale proceeds that represent the actual cash that we get from selling the 30% we really did sell. And then we get the fake sale proceeds for selling the 10% we didn't sell. You might remember these fake sale proceeds are often called deemed sale proceeds because, let's face it, fake sounds a bit scary in financial reporting. Yeah, I do remember seeing the actual sale proceeds. Again, very hard to read it straddling the page here. But Banana disposed of the 75% of its 40% investment on the 1st of October 2006 for 19. So that's the fair value consideration for the selling of the actual 30% that we actually sold. Oh yes, my throat's a lot better there. I really accented the actual and didn't hurt myself. I sounded like a Scouser, didn't I, when I said actual? I always do. Class is another one where I always sound like a Scouser. Otherwise, I don't. We need to have a hard return there. So we need to find the fake sale proceeds that we would have got if we had sold what we didn't sell. So here we go. At the date, Banana lost its right to appoint one director. The fair value, we're not waiting long. The fair value of the remaining 10% equity was 4.5 at disposal. Wow, but only 4 at the year end. Goodness me, so we're going to figure out what to do with the 0.5, but not just at the moment. Hang on. So at, we've got that 4.5. If we had have sold the 10% on top of the 30%, we would have got 4.5 on top of 19. There you go. Managed to spit it out. So 4.5. And what this is saying is that if we had sold the whole 40%, we would have got 23. Just have a look at that again. If we had sold the whole 40%, we would have got 23. And we really are pretending we have sold the whole 40%. And then we just compare it to the exit carrying value. There's only one carrying value for an associate. So the exit carrying value is the figure from above. You know, it's the associate carrying value of, I forget now, what was it, 20.4? 20.4. So we carry that figure from one part to the next. 20.4, and it is actually perfectly reasonable not to work out the profit, just leave it like that. But on the other hand, we can probably do it in our heads. So what do we say that was? 23.5. So is that 3.1? 3.1.
Sorry, Martin, is there not a gain?
Gain, yes. Profit on disposal. Oh yeah, here's the loss on disposal. It so often is a loss on disposal. That would be fine as it is. I think it'd be very confusing for you guys.
Just wanted to check. Thank you.
Yeah, it is. Yeah, absolutely. Please don't worry about that. If you had done that, you kind of assumed it was going to be a profit and it turned out to be a loss, and you didn't adjust your title, it turned out to be a loss, and you know you thought it was going to be a loss, as I did, and it came out to be a profit. It's fine. No one cares. A profit and loss are the same concept. One is just positive, the other one's negative. That's all it is. They are the same thing. That's a lot of work for 2 marks, isn't it? And then if you go back to the question, it has an and. If you go back to the question, it has an and how the investment in Strawberry should be accounted for after the part disposal. I mean, this is getting insane now, because the remaining 10% is, of course, a equity financial instrument investment. And when you have an equity asset, when you have a financial asset, you've got the 2 questions. Imagine whacking down the knowledge for the 2 tests and then applying them. I mean, I'll say it out loud because they're so regularly examined. The cash flow characteristics test, the asset must be solely interest and principal. And the business model test, there must be the intent to keep. We do the SIC test quite quickly. Solely interest and principal. There's 10% equity is 10% equity, and therefore fails the SIC test, and therefore the asset must be carried at fair value. But imagine typing that all out. That'd take forever, wouldn't it? Oh, and then hang on. Once it's at fair value, do the gains go to the P&L or to the OCI? Do you remember how it works when you have an equity asset? If you have strategic equity with the intent to keep, it's FVOCI. And if you have speculative equity with the intent to trade, then it's FVPL. I find it really useful to use that information in this context, because I can do it relatively quickly and I can get the knowledge down and then apply it to the scenario. So that's what I'm going to go for here. I'm going to go for, you know, knowledge on equity assets. Yeah, it is the distinction. And then, as I say, I'm really fond of tables, so I'm going to go for a table here. I've really thought this through, maybe like that, maybe, I don't know. So what shall I start with? I'll start with what, the asset, maybe, which would be, oh no, I got a good one. That's a great title. And then 2 kinds of fellas are speculative and strategic. And you might remember one has the intent to keep, and the other has the intent to trade. Yep, that's the intent. And then the class that comes out of that is, just make sure we get it the right way around. Speculative is FVPL, whereas strategic is FVOCI. It's very tempting. I don't know exactly why it is, but it is for some reason very tempting to just whack down an answer here and just assume it's one or another. It seems a bit mad after you've put all that effort. Let's just go and read and find out what the examiner tells us as regards the intent. Is it to sell the remaining 10% or keep the remaining 10%? So here we go back into the story. Where are we now? Banana has recorded a loss in reserves of this and completely cocked up the whole thing. You know, it would take a year to unscramble this nonsense. Don't go there, just keep going. Banana has recorded a loss in reserves of this. Banana has stated they have no intention to sell the remaining shares and wish to classify as FVOCI. Okay, so there you go. They have no intent to sell, so they have the intent to keep, so they can classify FVOCI. So there you go, so there's the intent. So this is indeed FVOCI. We're not going to explain it properly, there isn't time. So here we go with FV. Oh, what did I do there? Oh, Control F, that's find, isn't it? So I want Control B. Yeah, Control B, Shift F. The intent to keep shows that the following should be recorded. I guess Shamaz, because after all, this is a financial asset carried at fair value. We should be doing it with our information with a journal, I guess. So here we go, let's insert another table. And what we're going to do is we're going to make the investment go down. The investment is an asset and therefore a debit. We're going to make the investment go down from 4.5 to 4, and therefore we're going to credit the investment. It's just struck me, you might not have spotted that, so I'll go back and show you where I got the figures from, but I'll whack it down for now. So the investment is going to drop by, the difference between 4.5 and 4, the fall in value, in other words, and that's going to be 0.5, and of course this is FVOCI, so the 0.5 is going to go into the OCI and would be called something like, strategic equity loss. That would be the debit. You can see that my intent was to focus on the intent there, and I just realized that you might have missed the detail as regards the numbers. So let's go back again. What I'm trying to do is figure out what to do with the 0.5. What 0.5, Martin? So let's go and get the 0.5. The fair value of the remaining 10% goes from this to that. That's what I'm trying to work out. So that sentence, what to do with that sentence. Okay, so the fair value of the remaining 10% was 4.5 at the initial measurement point, but only 4 at the year end. So there's a fall from 4.5 down to 4. That fall on the balance sheet is just a fall in the balance sheet and creates a loss. But should the loss go to the P&L or to the OCI? That was the bit I was focused on, wasn't it? Well, it'll go to the P&L if this is speculative equity, but it'll go to the OCI if it's strategic equity. I've now suddenly got really concerned that I've misread this in some way, because it is a bit bizarre to want to sell the 30% but want to keep the 10%. But I think that is what's written, isn't it? I just suddenly thought about it. Banana has stated that they have no intention to sell and wish to classify FVOCI. It just shows you the examiner has not thought how bizarre that is. The reason is because he's watching Match of the Day while he's writing this question. He's got no interest whatsoever in you. As long as he slaps down a question and he earns some money for his pension, he's happy. Okay, so you take the same attitude with him. You slap down your rubbish as fast as you can and you say, have it. And then you're on to the next question. So I am happy with that now. It does appear that this is bizarrely FVOCI. We want to sell 30%, but we want to keep 10. Why? Why don't you just want to keep the whole 40? I don't know. So there you go. I can see Wellers has very patiently been waiting for me with his hand up there. So I will invite him now to speak, if I may. Fire away, Wellers.
Hello, I've probably forgotten the question. No, I'm joking. Martin, I wanted to ask with regards to the one director.
Yeah.
What is the actual condition? What about if you buy 30% in a company? That percentage, doesn't it give you, it's an associate? For you to have power to participate, is it that it automatically triggers having to appoint a director, or sometimes you don't have to appoint a director? It's only the percentage. That's what I wanted to get clear.
I'm not exactly sure how to answer that. I think you haven't figured out the difference between concrete evidence and corroborative evidence. I think that's your problem. I don't know. I'm not exactly sure. I think your first problem is you don't believe that the IFRS says what it says. You can search it if you want to. Go to iesplus.com and find out what the definition of an associate is. So an associate is defined by influence, and influence is the power to participate in management policy. That's what the standard says. The standard then goes on to say that the standard then goes on to say that certain percentages can be indicative of influence. So Wellers, you walk in and you find my gruesome dead body on the floor of your kitchen in front of you. And there is Phil right over my body, covered in blood, with a kitchen knife in his hand. And your immediate reaction is, Phil, you done it. You done it. But you're a sensible guy, Wellers, and you live in London, so you have CCTV. When you play back the CCTV, you find actually Phil was trying to save my life. Sorry, Phil, you didn't succeed. I died there in front of you. It must have been very emotional for you. But what actually happened was that Luke came in and stabbed me and ran out that back door behind you. That's the actual evidence. You don't anymore need the impression that Phil did it because he's covered in blood and he's got the knife in his hand. That's now irrelevant. Do you agree? You've got the flipping CCTV. You're not looking for percentages, Wellers, as corroborative evidence when you've got direct evidence of influence, the power to participate in management policy. I mean, just think about what those words mean. They're, you know, the power to have your voice heard in amongst the management team. You've got a seat on the board. You could have 1%. If you've got a seat on the board, you'd have a 1% associate. The percentage is completely irrelevant at that point. So you've got to stop looking at Phil with the blood on his hands and concentrate on the fact that you now know it's Luke and try and hunt him down because, you know, he's running out across the estates. I think that's what your issue was. Having said that, though, just to say this out loud, you know, obviously, if you don't mention the directors, you haven't got the point. But if you mention the 40% as well and said, the 40% actually does corroborate the real evidence. The real evidence is the direct on the board, isn't it? But if you'd chosen to talk about the fact that the 40% further corroborates this, that is okay. That is a point. It's just not a point that I chose to make, because I mean, you know, you can see it is really basically an 8 marker with loads going on, isn't it? I know it's 2 4 markers, but really it's just an 8 marker with loads going on. And that's why I just kept my answer really, really short. I mean, you saw how little I did on the FVOCI. I really cut it short, didn't I? And I did the same thing with the influence at the top of my answer. Nothing is properly explained in this question, because the examiner says, you know, here's 8 marks. And he is saying to you what he seems to be saying, which is, don't try and properly explain yourself, just make 8 points. Give me a thumbs if you're okay with that. Cool, guys. Great. Now, what I am going to do is, of course, look at B and C. And I'll do it very briefly, but only so far as you can see that B and C could be examined anywhere in the examination. We're going to have a little look at them very, very briefly now, and then look at a bit more in a moment's time. Because what I'm heading towards is I want to set you up for Hill. I want to set you up for homework at this stage now. But I don't want to ignore the B and C. I want you to be aware of what's in the background. Discuss whether the directors are correct to treat Mellon as a financial asset acquisition, and whether the International Accounting Standards Board proposed amendments to the definition of business would revise your conclusions. That's a bit shocking, guys. It's your first citing of a current issue in the course so far. And of course, you've heard from me that current issues pop up all over the place, and they form an important part of our revision phase. And next Tuesday and Thursday, we've got a double header next week, haven't we, guys? Next Tuesday and Thursday, I'm going to go further into accounting and start to pick up current issues with you. One of the things that I'll be doing when I'm talking about current issues with you is starting on the Tuesday to look at the article pack, and then finishing it on the Thursday. The article pack is pretty hard going, so I would recommend, I'm not saying don't look at it, but I'm saying I recommend you don't look at it on your own, because I think you might find it intimidating. Having said that, please do what you want to do. I mean, Luke, I know, has had a look at it already. It is absolutely fine, as long as you're feeling tough and you don't. It's all this idea about treat every minute as if it was your last. And if you're reading something and things are flowing and you're learning from the thing, carry on doing the thing. It's just that when most students open up the article pack on their own, they tend to lose an hour of their lives that they're never going to get back, and they just end up weeping into their cup of tea. So don't do that. If you find that the article pack intimidates you, close it up, and I will open it up with you on Tuesday and then again on Thursday, because it is, it's technical. It's about the ISB proposals. And we are going to look at this proposal both tonight and also next Thursday. So we are going to look at these things. But what you're seeing there is something that very clearly, very definitely could be anywhere in the exam. And same thing with this part C. You might even recognize this part C. This is NOAA. Discuss how the recognition criteria. No, this is not NOAA. Oh, yes, it is closely related to NOAA. It's like a NOAA gone horrible. Discuss how the derecognition requirements of IFRS 9 should be applied for the sale of bond, including calculations, and how the impact on the consolidated F was. I remember this one. It's absolutely horrible. So the part A is, believe it or not, that was a really nice part A. I don't know how you felt about it, but once you've been through the whole course, you'll think that that's a babe of a part A. B and C, the examiner really bites your backside with those two, really nasty. But the idea is, that even when things get nasty, you can still pick up, if you can pick up 3 or 4 in each of those, then, it seems, I like saying this out loud, but it is a little bit scary to hear it. If you're getting a marginal fail in your worst question, you're passing. And I think that's a very important concept. If I get a marginal, if I can still fail this, but only marginally, then I can pass the whole exam. You see, the reason I'm saying this out loud is it's very common for students who think they can't pass a question to give up and score 0, which is just so wrong. Just because you don't know what the heck you're talking about doesn't mean you don't slap down some rubbish. If you slap down some rubbish, the markers will stick some marks next to it. It's gonna happen. So you slap down your rubbish, knowing it's rubbish, doing it as quick as you possibly can. And, you can just imagine, there's a couple of, literally it could be 2 parts of the examination you're really, really clueless about. And you manage to score 3 out of 7 over here and 3 out of 7 over there. And before you know it, you've got 6. And you would be unlucky to be marginal if you were, if you were marginal. But if you're at 44 and you get 6, that's it. You're never going to have to do this nonsense ever again. So I'll just say it again. I realize it's a bit intimidating, but if you want, there's the F word, if you get a marginal fail in your worst component, you're passing the exam. So if you're struggling with B and C, you're in common with other students, you're just trying to pick up marks there. And that's exactly what we'll do. But what I really wanted to do here was to show to you that, every question wanders all over the syllabus. This one is wandering all over the syllabus, even got a bit of current issues in there. And that applies to question Hill. So I'm now going to introduce question Hill. There's a couple of strange things about Hill. It's an absolutely lovely question, and it's actually from specimen 2. It's a real exam question, but as an SBR question, it was fake. But it is a real exam question. It's basically 2 old questions banged together. And what I want to do really is to particularly focus on part B. I really do want you to have a go at part B. I'm so tempted to guide you with part B, but maybe the best thing is, if you're going to have a car crash in part B, have a car crash in part B. If I guide you through the wreckage, then you'll never realize the tricks that I'm using when I use them next Wednesday. That's right. So this is going to be the subject matter for our mentoring session next Wednesday, just after lunch, 2 o'clock. Yeah. So I really, really do want you to do part B. Really want you to do part B. So much so, you might even do it first. Next thing to talk about is this, which is very odd. This is extremely strange. I don't know why the ACCA did what they did, but what they did was they gave to Graham these instructions. They said, you've got a section A and a section B. Section B has to be 225 markers, but do what you like with section A. And they suggested to him he does 30-20, which he has always done, and he's never done anything different. But he is allowed, if he wants to noodle with that. He could even have 32 and 18. In this case, he had 35 and 15. It doesn't really change the examination, but there it is, it's still 100 compulsory marks. I think any little changes like this are intimidating in the examination hall. We're having a tough enough time, what with not the nonsense going on out in the real world. We don't really want any 35-15s, but if it happens, it's still exactly the same examination. I know we're expecting 30-20, but it could be 35 and 15. So I want you to do all 35 marks, and I'll be giving you a mark out of 35. Now, coming to part A, this was the one I was thinking of. This is Noah. My apologies. This is Noah. Really, really nice little bit there. So, that's a bit of financial instruments accounting right in there. And then this is your groups. Oops, that didn't highlight very well. Maybe go for the 1. This is your groups. And this is your groups. And you've probably guessed it's very, very similar to the previous question, where there's an acquisition of a subsidiary. They do measure goodwill, but they cock it up. That gets parked in part A1. But in part A2, there's an associate. Of course there is. You've guessed that already. I think I'll just go a little bit further. And that is, you can see that the mark allocation is very high here. The reason I want to go a bit further here is Graham kind of regretted that. And one of the things that he did when he launched his first exam paper is he broke that down into subcomponents. You see, the reason that's 13 is it is essentially exactly the same as banana part A, part 1, but it's got this little impairment on the back end. So it's 8 marks on the goodwill cock-up, but there's a missing impairment being unrecorded at the end. So it's kind of 8 and 5. The truth is that when the examiner doesn't clarify how the marks are allocated, you can play with them how you like. So you could do 9 and 4 if you wanted to, but I think probably the easiest is 8 and 5. So it's basically 2 requirements. Now, if the examiner was to rewrite this question and dump it down as your Christmas exam, as your December examination, then I suggest what he would do is he would break that first part up into A1 and A2. And A2 would become A3 and A4, A3 would become A4, etc. And everything would be pushed down. So you'd end up with separate requirements, which would be an improvement. You saw how we split up the strawberry story to help us out. That it was kind of this that influenced him splitting up strawberry, because he felt, you know, if I just bang everything together with strawberry and give you 8 marks, it's not clear where I want you to put the marks. Well, he had the same kind of experience with this one, and he adjusted it. As a result of writing this question, he learned from his mistakes, which was good. No, I can't think of anything else to say. Apart from practicalities, should we talk practicalities? I think it's 4 is the number of fingers I should be holding up. I think that's right. So the first thing is I do a question 1, then you do a question 1, or maybe it's 5. I do a question 1, then you do the question 1, then you email to me, then I send you my answers. There's 6. Then I mark, and then we debrief. Wow, that is a lot of things that happen there. So I'll just say that again. Maybe the fingers are not helping. First thing is, I've done question banana. So over to you now to do question hill. Then you email it to me. Over the weekend, anytime is fine. I have scheduled a email to you, an announcement actually it's called, an email to you which has the answer. It's scheduled to leave on Monday morning, if I remember correctly. So what it'll do is invite you to the 3 sessions for next week, give you the codes and all that usual stuff, but also it'll have attached to it my answer to question hill. I would suggest the first thing you do is you mark yourself, and then I'll be marking you. I guess it must be on the Tuesday, I'll be marking you, and then we'll meet on the Wednesday and we'll have a little debrief where I talk about the tricks. You can be damn sure I'll be talking a lot about part B and how to see your way through this, and how to, it's actually, believe it, I'm in danger of saying too much here because I don't want to give it away, but it's actually pretty easy to score 9 marks if you see the tricks. So I'd like you to try and think of this as, you know, I'm going to do this strategically rather than answering the question directly. I'm trying to think, how can I get 9 marks? That's what I'd like you to do with part B. And I'll be doing that. I'll probably start with that, and then we'll have a look at a few other bits and bobs as regards the technical components of this question, because there is some quite techie stuff in there. There's a few traps. There's a really nasty trap in A1, and we'll definitely be talking about that. But again, I don't want to give too much away, because if you fall into those traps when you're doing this question on Saturday or Sunday, it's good for you. You know, you go, right, I fell in that trap today. I'm not going to do that in the real thing. So sometimes it's good to fall into these traps. I feel like I've covered the angles there. So fire away. Was that you, Jihad? Did you want to ask a question? Anyone? Am I seeing any mics open? No, no. Shamoya, please open up your mic and ask. Feel free.
So with the calculation of goodwill and disposal, there are only 1 marks and not 3?
Yes. Yes. I know what you're thinking of. You're thinking of the profit on disposal of a subsidiary. Yes, the profit on disposal of a subsidiary, which does sit in Question Hill, is worth 3. This was, so the calculation of goodwill at the end, I think you're asking me about banana. So question banana, all of those points were 1 mark each.
Okay,
so
but if I
calculation of goodwill was 1 mark. And the profit on disposal of the associate was 1 mark. The profit on disposal of a sub is 3 and is in Question Hill and has been examined since when it's been 3. Did you understand that?
I think so. So if I see an associate, it's only 1 mark and sub 3.
Yeah.
Okay, cool.
Yeah.
Thanks.
Yeah, no problem with you. That's fine. Anyone else? Any questions? All right, so shall we finish by
Sorry.
fire away, dear? Yeah.
Sorry, I've got a really stupid question. You're probably going to hate me for it. Okay, so if I fail this exam, when can I sit the next one? Just whenever I won, or?
Yes.
Okay, and do the London School of Business have the policy that they pay for the second one or something?
Yeah, you have to fulfill certain criteria, which I'm not an expert at, so please do check your policy documents.
Okay.
But yeah, I think it's something along, please don't quote me on this, do check your emails and everything, but the don't pass, don't pay guarantee is something along the lines of you have to have good attendance for the live sessions, good attendance for the revision sessions. You have to then submit a mock and get 30%, I think is the key 3 components. But please do check your emails to verify that. Are you planning to fail, are you?
I'm not planning, honestly, I'm not. I
Give it a
feel
go.
like I'm dead. I'm
Yes.
going to give it a good go. I am.
Give it a good go. Good go.
Yeah, thanks. Thanks.
Yeah, it's a roll of the dice. So, you know, being realistic, anyone can get unlucky. Yeah, perfectly reasonable day.
All right, thanks, Martin.
All righty. So let's finish this evening by having a look at part B and part C. Now, what I'm going to do, if you will allow me, is I'm going to debrief both answers. I think what I'd like to do is I'd like to just talk it through. Now, of course, you have detailed answers to question banana already. You actually have the answer to the groups component already. You've got the 8 marks of the 2 8 marks, the 16 marks that I've done so far. You've got it already in your answer, but you've certainly got the 2 7s as well. But I think what I'd like to do is I'd like to talk about part B and part C and get you to get the essence of it. I'm not that excited about part B, but certainly keen to give you the flavor for part C. But I think Shamaz has a question. Oh, Shamoya. I think Shamoya's sorted.
Yeah, I have a question.
Yeah, fire away, Shamaz.
So just wanted to check, are you running any like morning classes for revision?
No, there's only afternoon.
Only afternoon.
I thought you were in Canada, Shamaz. Why did I think you were in Canada?
Yep, I am in Canada. Yep.
Ah, yeah. So morning works because that's your evening.
Yeah, no, I'm just thinking about the clash for the other schedule. So I'm just trying to think if I can like sort of offset it by having like a morning class for SBR and maybe an evening for AAA.
Yeah.
But no, the
classes are scheduled. It would be difficult to start noodling with it now.
Okay.
Yeah. Did you have snow last week?
Yeah, just a bit, not a lot.
Yeah, one of my wife's friends had she's in Edmonton. She saw loads.
Yeah, I think Edmonton had quite a bit of snow, but not
already. Let's go and have a look at B and C. So here we go over to B. Have I got it up? No, that's the answer. What am I doing? Oh, of course, it's up here. Where am I now? Oh, I'm in Hill, aren't I? Okay, back to banana. Banana, there we go. Here we go. So B and C of banana. B is a current issue. And current issues are areas of contentiousness in financial reporting. And some areas of contentiousness in financial reporting are under development by the International Accounting Standards Board. And there are only 3 areas under development that are relevant to your examination this December, just 3. There are 3 current development projects that the examiner could examine. There are 3 proposals that he expects you to know about. But of those 3, 2 of them are kind of a bit dead, to be honest with you, which really only leaves 1. And that 1 I really have battered to death on tuition already. It's that equity, debt equity problem that we were discussing when we had a look at financial instruments in question B. Once I start saying it, you might remember it's the story about there's a problem, then there's a solution, then there's a problem with a solution. Do you remember that one? So that's the one where equity is poorly defined, and because it's poorly defined, it's easy for creative accountants to noodle with the gearing ratio. It's a really big problem for shareholders. You know, they get shafted by dodgy directors, and the ISB are very sympathetic to this problem and trying to sort out the definition of equity. And we had quite a good look at that on the tuition course. It's so important, we're going to look at it again on Thursday. That's not this one, that's not this proposal. And then there's 2 more proposals. There's this one, which is okay, and then there's another one which is really marginal. But the trouble with Graham is he's quite capable of examining marginal. So I'm going to leave none of them. The one that we have here today is quite a cute proposal, but it seems to have gone a bit cold at the International Accounting Standards Board. It seems to have gone a little bit cold in the mind of Graham Holt. And it's the idea that calculating goodwill is a pain in the backside. Calculating goodwill is a pain in the backside. Now, you might remember that the IFRS on goodwill is actually called business combinations. Do you remember me talking about this? And 1,000 years ago, when we did the question pedal, saddle, handlebar, everything ends up being pedal, saddle, handlebar in the end, including this question. We introduced this idea of the business, and the business is the idea of people and things. A load of people crawling on some things to make money. You know, things combined with people, that's called a business. So that's the idea of goodwill. Now, if you have a business, then you must pull out the goodwill. You must measure the goodwill. You must calculate the goodwill if you have a business, says the IFRS. Well, why would that be a problem, you ask perfectly reasonably? Well, it is a little tricky to answer without an illustration. And I'm trying to think which one I want to go for. I think if you'll allow me, I think I'm going to go for the London skyline, which is obviously going to work a lot better for Londoners than it will for those who are not in London. There's a huge building going up just over there. Absolutely ginormous. Actually, it's up now and the glass is on, but it's not finished. They've all got names, these buildings in London. And this one hasn't got a name yet, hasn't got a nickname yet, but I want to call it the Basalt Building because it reminds me of columns of basalt, like like Giant's Causeway in Northern Ireland, that kind of thing. It's just an incredible building, and it's absolutely massive. It towers over Tower 42 that it's next to. And the building is not finished. And imagine Wellers. Oh, Wellers, you're so wealthy, wealthy Wellers. You buy that half-built building. Wellers buys the half-built building, right? And you know, it's got some security guards. It's a half-finished building. All right, the glass is on. All right, the glass is on. The floor is in, but absolutely nothing else is in there. There's no, you know, there's no, the concrete floor is down, but the floating floor is not down. The floating ceiling's not down. There's no lighting. You know, there's definitely no toilets. So it is, you know, I realize it's all the way up, but it's definitely a half-built building. And most importantly, there aren't any customers. Actually, there is a little bit of interest from customers, and you do have some security guards in there. There's a little bit of people involved in that building over there. I've even seen lights on there, and you know, that could be the cleaners cleaning up. You know, there clearly are people involved in it, but the amount of people value in that building at the moment is absolutely tiny. And what Wellers says is, don't make me calculate goodwill. It's going to be so tiny, and working it out is going to kill me. It's going to be a tiny amount of goodwill. Can't I ignore it? Says Wellers, as he pleads to IFRS 3. And IFRS 3 says, no, calculate goodwill. This is a business. It has people. It has things. You must work out goodwill. So IFRS 3 has no threshold. If you have a business, you must calculate goodwill, no matter how small it is. And what businesses have complained about is that's a pain in the backside. When goodwill gets really small, can't we ignore it? And the answer is no at the moment. IFRS 3 has no threshold. No matter how small goodwill is, you have to work it out, according to IFRS 3. However, the International Accounting Standards Board was sympathetic to this complaint when it came through many years ago, in about 2013. And what they did was they proposed something really simple, and that's this proposal. The proposal is, when goodwill gets really small, you can ignore it. That's the proposal. All right? So the proposal is actually quite simple. When goodwill gets really small, you can ignore it. And under what circumstances would you have the goodwill getting really small? Well, it tends to be when the asset's very big and it doesn't really have many customers. So that would be a half-finished building. You know, the Basalt building is just next to Heron Tower as well, and Heron Tower is fully occupied, so it would have massive amount of goodwill. So Heron Tower, no. And right next to the Swiss Re building, otherwise known as the Gherkin. So the Gherkin is fully occupied. That's got customers. Obviously, if you bought the Gherkin, well, you'd obviously have to pull out goodwill because look, it's full of people, or at least it was until COVID. It's a fully occupied building. But the Basalt building, as I say, is half finished, and therefore the amount of customer value in there is tiny. Another one, you know, might be, say, you've got a tanker in dry dock. Clearly, if you've got a tanker, an oil tanker out at sea with, you know, customers lining up to use this tanker, and there's even oil in the oil tanker, and the oil belongs to a customer. Obviously, you know, there's customer value in a tanker when the tanker is out at sea and it's got customers interested, obviously. So if you bought a tanker, Wellers, then you'd have to pull out the goodwill as well, obviously, you know. But if you had a tanker in dry dock, it's got no oil in it and it's being mended, but it's got a few customers sniffing around, then it has a tiny amount of goodwill, which is just, and at the moment, you would still have to calculate the goodwill because IFRS 3 says if you've got a business where people are involved, then you have to work out the goodwill. But the proposal is going forward, if goodwill gets really tiny, you can ignore goodwill. That is the proposal there. Now, I hope I sold you that idea. That is all the idea is. Having said that, now it isn't enormously hot, it has to be said. That was hot a couple of years ago, and it seems to have gone a little bit cold, both in the ISB and also in the mind of the examiner. But you never know, you're a crazy examiner, so it's worth knowing. All right, so The proposal is if goodwill gets tiny, you can ignore it. That's that proposal. More proposals next week on Thursday. Give me the thumbs for that. What I'm more interested in is part C. And part C, the examiner was trying to be helpful here and he kind of cocked it up. Let me wake up the mouse. Oh, I haven't replaced the batteries. We had this last time, didn't we? It's cold down here. Let's do that when I go offline just now. Is that open it up? Oh, well, I got the mouse pad, haven't I? I can use that. So I need to share screen, don't I, and show you the question. Now, the question is not the most helpful because it references IFRS 9, which kind of intimidates you. It's very, very techie question, the way it's written. It's not really intended to be like that. Discuss how the derecognition requirements of IFRS 9 should be applied in the sale of the bond, including calculations to show how the impact on the consolidated financial statements. It sounds enormously techy, and it is kind of techy, but let me tell you a little bit about what's going on here so you get the idea. It's all about this thing here. And sorry, it's not as easy as I thought using this mouse mat. No, I managed it. You remember doing this in sale and leaseback? When is a sale not a sale? When it's not a sale. But what do we test for? Well, a sale is recognized as a sale when it is a sale, when you transfer the risks and rewards to the counterparty. If you keep the risks and rewards during the sale, then the sale is not a sale. That's the idea. It's the idea that sometimes a fake sale reveals a loan. Now, what sort of things can and have people used as security for loans? Well, of course, very famously, people can have and do all the time use buildings, use property as security for loans. But it's actually quite common to use all sorts of assets for loans. All sorts of bizarre things I've come across. Some things that you might have come across is you can use stock as security. You can use receivables as security. You can use football players as security. And in my favorite example, David Bowie even used his songs as security. He didn't sell his songs for $300 million all those years ago. I do wonder if that was when he got his news about his cancer that he kept secret for all those years. He did a sale and leaseback of his songs. He didn't really sell his songs. What he did was he got a loan of $300 million in order to enjoy the value of his songs, and then he paid back the $300 million and handed over the songs to his wife, and then it's going to go to his kids. So he still owns his songs, or his wife still owns his songs. But it's the idea that you can use anything as security. You really can. You can use property as security. You can use stock as security. You can use receivables as security. You use footy players as security. You can use songs as security. This one here is very tricky because they use, are you ready for this? They use loan assets as security for a loan liability. Ooh, that's really hard to read at speed. So the story starts talking about a loan asset, but it's really talking about the fact that there is a new loan liability. Let me show you the story so you get the idea. It isn't easy, this, but I want to show you this again because I'm not saying it is coming up in the December examination, but it's coming up sometime over the next 5 years, maybe in December. Now, just remind yourself of the dates. So the date of our year end is the 30th of June 2007, which means our year starts on the 1st of July 2006, right? And then what he does is he tells us about something that happened last year. Now, talking about last year is not fundamentally wrong, but is rarely what the examiner is asking about. Just have a look again at the requirements. Where is it now? Discuss how the derecognition requirements of IFRS 9 should be applied to the sale of the bond, including figures for this year. So it isn't wrong to talk about last year's purchase of the bond, but actually the question is not really about last year's purchase of the bond, it's about this year's sale being a fake sale. So let's see if we can show that this sale is a fake sale. Well, the story starts with the purchase of the bond that's going to form the security. On the first day of last year, Banana acquired 10 million 5% bonds at par with interest being due on the 30th of June each year. The bonds are repayable at a substantial premium so that the effective rate of interest is 7%. Banana intends to hold the bonds to collect contractual cash flows arising from bonds and measure them at amortized cost. Don't get me wrong, you can get marks there by talking about last year. You can whack out the cash flow characteristics test, you can whack out the business model test, you can fulfill both of those, you can get the conclusion that these should be carried at amortized cost, and you can do some numbers. But the question isn't really about the asset, it's about the liability. What liability? It isn't really about last year, it's about this year. What this year? Have a little look again. So on the 1st of July 2006, that's the first day of this year. The opening paragraph is really just setting the scene. The action really takes place from the 1st of July this year. On the 1st of July, Banana sold the bonds to a third party for 8. Okay, you know, you can buy and sell stuff, that happens. The fair value of the bonds was 10.5. What? Banana sold the bonds for 8 when they're worth 10.5. How does that happen? Something weird's going on. Banana has the right to repurchase the bonds. Oh, okay. And it's likely that the option will be exercised. Huh? The third party is obliged to return the coupon to Banana. What rewards do you get from owning a bond asset? What rewards do you get from owning a debt asset? You get interest, don't you? Hang on. So we've sold the bond, but we're still getting the interest. Huh? The third party is obliged to return the coupon to Banana. And pay the additional cash to Banana should the bond value rise. What? Banana will also compensate the third party for any devaluation. Oh my days. Of course, after the sale of the bond, Banana continues to retain the risks and rewards. You can't sell something and then keep it. So the sale is a fake sale. Oh, of course, the 8 million is well below the fair value of the asset because the 8 million is just a loan, of course. And look, we're going to be paying back 8.8. Oh, I get it now. The 0.8 is interest. That's the story there, the really important story. Now, the other stuff on the first paragraph talking about, you know, accounting for the bond itself, the bond asset, sorry, the bond asset is okay, but the problem with it is it's all last year's story, and as best as you can, you try not to talk about last year, try and talk about this year. We've talked about the idea of, you know, focusing on the current year as much as you can. What happens this year is that there is a fake sale. You prove that the fake sale is a fake sale by showing that Banana continue to own the risks and rewards of the asset. The risks and rewards have not been transferred, therefore the sale is not a sale. If the sale is not a sale, then it must be a loan. And then you'd recognize the loan liability on the bottom of the balance sheet, and there you go. And before you know it, you've built up, 7 marks in answering that. The real key is just to open the door with the key. Once you've opened the door with the key, the rest of the marks tend to flood in. So what should you do with the sale? You show the sale is not a sale. What is a sale? It's a transaction where you transfer stuff to somebody else. So if you transfer stuff to somebody else, the risks and rewards should go out, but the risks and rewards haven't gone out. Therefore, the sale's not a sale. Well, if the sale's not a sale, well, what is it then? Oh, of course, it's a loan. And do you recognize that from sale and leaseback? This isn't a sale and leaseback, but it's unbelievably similar to sale and leaseback. It's a secured loan using, this is the extra layer of complexity, is it is a loan liability, a secured loan liability using the loan asset as security. It's very hard to read at speed, and I remember marking this when this was set by the examiner, and us markers, we were enormously generous to people, and people were just sort of struggling around and trying to pick up stuff in there, which is absolutely fine. When something comes up for the first time and it's really alien and difficult to read, I mean, what you're supposed to do in 7 marks worth of minutes in the exam, you can't really do very much, can you, when you're seeing something for the first time? But this has now been examined, and therefore, if it comes again in a similar guise, then the better students will pick up on this. They'll go, I know this, I've seen this. This is banana part C. I recognize it. It's a fake sale. The risks and rewards still remain with banana. Therefore, the sale isn't a sale. Therefore, the loan must be a loan. Off I go. Bop, 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 bop. Oh yeah, and the difference between the cash I receive and the cash I pay back, that's the interest. Yeah, I get that. And before you know it, the better students have picked their way through the story quite quickly. That is all about question practice, and that's why you're going to do banana this weekend. So guys, shall we say that's us sorted?
Do you mean hill? Sorry, do you mean hill, Martin?
What did I say?
We're going to do banana.
Yeah, you are going to do banana. You are going to do banana. Do banana a couple of times, okay, and then have a go at question hill. Yes, indeed. Question hill is the homework question. My apologies. Just stuttering there at the end. Any other questions, guys? Can I just check with my would-be classroom dudes? Kieran, Taya, Wajiha, Arifa? Any questions at all, guys? Anything you want to ask? You can always email, of course, but we're here now, right? Nope. Okay, lovely. If you think of anything at all, you four, or indeed anyone at all, I'm always here for you. Thanks again for listening to me, guys. Have a super evening, what remains of it. And yeah, I look forward to seeing you on Tuesday. So it's Tuesday teaching, Wednesday mentoring, Thursday teaching. Have I said that right, Luke? You're looking slightly puzzled there, but I think it is right, isn't it? Have I said that right, Phil?
Yeah, it's just going to be tiring, I think.
Yeah, it's going to be exhausting. Especially because I'm going to slap you about with current issues. Yeah. But
yeah, that's right, Martin. Yeah. So Tuesday, Wednesday, and Thursday.
Yeah, so prepare to be duffed up by Friday. Oh, there you go, a bit more scales. So take care, guys. Have a super weekend. Work really hard, and if you need anything from me, please feel free to email. Thanks again, guys. All the best.
Cheers, Martin. Thanks. Bye, guys.
Take care, guys.
Bye.